Did you know that nearly 90% of stock market investors lose money? Shocking, isn't it? Welcome to a reality that many face when they take the plunge into the world of stocks. The stock market, a vast and complex beast, can be a goldmine for some, but a minefield for many. The reason? A simple yet profound lack of knowledge about how to analyze and value stocks. You see, investing in stocks isn't about throwing darts in the dark and hoping to hit a bullseye. It's about understanding the nuts and bolts of a company, its financial health, its market standing, and its potential for growth. It's about reading between the lines of balance sheets, income statements, and cash flow statements. It's about making sense of ratios like price to earnings, debt to equity, and return on equity. It's about fundamental analysis, digging deep into a company's fundamentals to assess its intrinsic value. It's also about technical analysis, studying price patterns and market trends to predict future movements. It's about finding the sweet spot between a stock's intrinsic value, its relative value compared to other similar stocks, and its market value. But don't let these jargons intimidate you. They are simply tools of the trade, keys that can unlock the secrets of successful investing. Remember, every successful investor, from Warren Buffett to Peter Lynch, has mastered these tools and used them to carve their path to wealth. But here's the thing, the stock market is not a get-rich-quick scheme. It's a long-term game that rewards patience, diligence, and smart decision-making. It's a journey of learning, growing, and constantly adapting to the ever-changing market dynamics. So while it's true that many investors lose money in the stock market, it's also true that those who take the time to educate themselves, who learn to analyze and value stocks, significantly increase their chances of success. They are the ones who transform the stock market from a game of chance into a game of skill. But don't worry, in this video you'll learn how to analyze and value stocks like a pro and increase your chances of success in the stock market. Let's take the case of Apple Inc., a company most of us are familiar with. Now imagine you're considering investing in this tech giant. How would you determine if it's a good buy? This is where the art of stock analysis comes into play. Two main types of analysis are used in the stock market: fundamental and technical. Fundamental analysis looks at a company's financials and market position. It's about understanding the business inside out. On the other hand, technical analysis focuses on price movements and trading volumes. It's about identifying patterns and trends in stock prices. So, if we're analyzing Apple, we'd start with its financial statements. These provide a wealth of information about the company's financial health and performance. The balance sheet, for instance, gives us a snapshot of Apple's assets, liabilities, and shareholders' equity at a specific point in time. It's like a financial X-ray of the company. The income statement, on the other hand, shows us how much money Apple made or lost over a period. It lists revenues, expenses, and profits or losses. It's a measure of the company's profitability. The cash flow statement is another crucial document. It shows how much cash Apple generates and spends in its operations, investments, and financing activities. It's a gauge of the company's liquidity and financial flexibility. Now, let's talk about financial ratios. These are numerical relationships derived from a company's financial information. They help us make sense of the raw data. For example, the price-earnings ratio tells us how much investors are willing to pay for each dollar of Apple's earnings. It's a measure of the company's market value relative to its profits. The debt-equity ratio, meanwhile, shows us how much debt Apple has relative to its equity. It's a measure of the company's financial leverage and risk. The return on equity tells us how efficiently Apple uses its shareholders' money. It's a measure of the company's profitability from its equity. Now, you're getting the hang of it, aren't you? But analysis is only half the battle. The other half is valuation, which we'll cover in the next scene. Stay tuned. Now that you know how to analyze stocks, it's time to learn how to value them. Let's dive into the world of stock valuation. There are three primary methods to do this: intrinsic value, relative value, and market value. Think of these as different lenses through which to view the worth of a company's stock. First up, we have intrinsic value. This method is a favorite among value investors, including the Oracle of Omaha, Warren Buffett himself. The intrinsic value is an estimation of what a company is truly worth, independent of its current market price. It's like peering into a crystal ball to see the company's future cash flows and discounting them back to the present using a rate of return. Let's take Apple Inc., for example. By projecting their future cash flows, adjusting for growth, and discounting back to present day using a rate of return, we can estimate their intrinsic value. This gives us a ballpark figure for what each Apple stock is really worth. Next, we have the relative value. This method involves comparing the company to its peers in the industry. For instance, we might look at the price-earnings ratio, which is simply the market value per share divided by the earnings per share. If Apple Inc. has a lower price-earnings ratio than its competitors, it could indicate that it's undervalued, or in other words, a potential bargain. Finally, we have the market value. This is perhaps the simplest concept of the three. The market value is just the price at which the stock is currently trading in the market. It's what you would have to pay if you decided to go out and buy a share right now. But remember, the market price is not always an accurate reflection of value. The market can be influenced by a host of factors, from global events to investor sentiment. Now you might be thinking, which method is the best? Well, the truth is, there's no one-size-fits-all answer. Each method provides a different perspective, and all three can be useful in different scenarios. You might use intrinsic value to identify potential bargains, relative value to compare companies in the same industry, and market value to understand current pricing trends. Remember, stock valuation is as much an art as it is a science. It requires a good understanding of the business, the industry, and the broader economy. It's not just about crunching numbers, it's about understanding what those numbers mean in the context of the business. And voila, you've just valued your first stock, but there's more to this. Stay tuned as we take a look at some of the best tools and resources that can help you on your stock valuation journey. Now you might be wondering, where can I find all this information? Well, let's dive right in. To get you started on your journey of stock analysis and valuation, there are a plethora of tools and resources at your disposal. First off, financial news websites are your go-to source for all things market-related. Websites like Bloomberg, CNBC, and the Wall Street Journal offer up-to-the-minute updates on market trends, financial news, and economic indicators. They also provide insightful articles and analysis that can help you understand the broader market context and the factors that drive stock prices. Next up, stock market databases. Websites like Yahoo Finance and Google Finance provide comprehensive financial data for thousands of publicly traded companies. These platforms allow you to delve into a company's balance sheets, income statements, and cash flow statements. They also offer historical stock price data and key financial ratios, which are crucial for your fundamental analysis. Software solutions for financial analysis also come in handy. Programs like Excel offer a flexible and powerful platform for crunching numbers and performing complex calculations. More specialized software like YCharts and Morningstar Direct provide advanced tools for financial modeling and stock valuation. Now, don't forget about the good old-fashioned books. Books written by investing gurus like Benjamin Graham, Warren Buffett, and Peter Lynch can offer invaluable insights into the art of stock analysis and valuation. They contain timeless wisdom and practical strategies that can help you navigate the stock market with confidence. When using these tools and resources, it's important to stay critical and open-minded. Don't just take the numbers at face value. Dig deeper, ask questions, and always strive to understand the bigger picture. Remember, the goal is not to predict the exact future of a stock, but to understand its value and potential risks. With these tools and resources, you're well on your way to becoming a pro in stock analysis and valuation. Congratulations! You've just learned how to analyze and value stocks like a pro. We've journeyed through the fascinating world of the stock market, dissected the art of stock analysis, and even cracked the code of valuing stocks. We've differentiated between fundamental and technical analysis and explored financial statements and ratios. We've also unlocked the secrets of intrinsic, relative, and market value. Remember, this is just the beginning. The stock market is a vast universe, and you've only just scratched the surface. The key to success is continuous learning, relentless practice, and fearless investing. The best investors are those who never stop learning and evolving. Now it's your turn to apply what you've learned. And remember, the stock market is not a gamble, it's a game of skill. So keep learning, keep practicing, and keep investing. Don't forget to like, share, and subscribe for more investing tips and tricks. Until next time, happy investing.